Hello everyone, my name is Nishan Parate and today we are here to discuss about the interest rate swaps and control of earning volatility with the example of Bajaj Finserv. Before that, let me start with a simple question. What happened to a financial company when interest rates suddenly change? So to answer this, let's discuss with the example of Bajaj Finserv. Bajaj Finserv is a diversified financial service group. It operates in lending, insurance and investment. Like all such company, it deals with the interest rate risk every day. Here is the core challenge. Many of its borrowing and its fixed interest rate, but many of its assets like loans and floating interest that change with market rate. When interest rate change, move up or down, asset and liability do not react in the same way. This creates imbalance, and this imbalance creates uncertainty in profit. So the real question is not whether interest rate will change. The real question is how does Bajaj Finserv manage this risk smartly? To answer this question, we first need to understand one simple financial tool, which is called RSS, interest rate swap.
Think of an interest rate swap like a daily life agreement. Imagine two people. One prefers fixed monthly expenses, the other is comfortable with changing payments. They agree to exchange payment styles so both feel comfortable. That is exactly how an interest rate swap works. In finance, a fixed rate means the interest rate stays the same. A floating rate means the interest rate keeps changing with the market. Through an interest rate swap, a company can exchange fixed interest rate payments for floating ones or the other way around without changing the original loan. Companies like Bajaj Finserv, for an example, use interest rate swaps not to earn extra profit, but to reduce uncertainty in the company. It helps them manage risk in a changing interest rate environment. Now, let us see how the swap becomes a fair value hedge.
So a fair value hedge is about protection, not protection of cash flows, but the protection of the value. When interest rate changes, then the market value of fixed rate borrowings also changes. This change can impact reported profits, even if the core business is performing well. So now let's talk about a fair value hedge. Works like a balance scale. If the value of the borrowings goes down because interest rate moves, then the value of the interest rates swap goes up. So one loss is offset by one goal. In practical terms, in fair value terms, we can state simply that it means how much a loan or borrowing is worth in today as compared to the yesterday because interest rates change. In financial year 2025, we had been seeing in the annual report of Bajaj Finserv that interest rate swaps as a fair value hedge so that interest rates movement do not distort into financial results. This treatment follows guidance from the company's financial year 2025 annual reports and Indian accounting standards hedge principles, which are also aligned with RBI's risk mitigation expectations.
Today I will be talking about the connection between asset liabilities management, also called ALM, and interest rate swaps. Before I begin, think about your own company, your income and your expenses. If they don't move together, we feel stress. In the same way, companies also try to balance what they earn and what they have to pay. This balance is called asset liability management. So, asset liability management or ALM means balancing what a company earns and what it has to pay. Just like in our life, if income and expenses don't move together, we feel stress. Companies feel the same. For Bajaj Finserv, assets earn interest and liabilities require interest to be paid. Interest rate swaps help exchange fixed payment into floating payments. This makes assets and liabilities move together when interest rates change. So risk becomes lower, planning becomes easier.
I am Akshay Pandey. I am speaking on earning volatility final steps. When profits moves, profit and loss ups and downside when the interest rate moves. Hence, investors does not like surprises. They believe prefers stability and consistency. Bajaj Finserv address fair value hedge accounting systems for using this unsystematic risks. when interest rates changes, the gain or loss arising from interest rate swaps largely offsets the losses and gains in the profit and loss statements. Hence, the Bajaj Finserv already calculated the risk before. They shows very technical and trust. Investor shows having the trust in the Bajaj Finserv, hence they use this system. So in financial year 25, their profit earned is stable, and when the interest rates moves, it's in technical errors.